Well, hi everybody. Thank you so much for joining us here. I'm Miguel, co-founder and CEO at Capchase. We are a Series B fintech company, and we help SaaS companies to grow faster with non-dilutive capital, with insights and tools and community.
Hi, I'm Kristen Clifford, and I'm an investor on the team at ZeroOne Advisors. ZeroOne Advisors is a VC firm for operators by operators. We're investing out of a $325 million fund in Series A and B companies across all sectors.
Right, so we're going to spend the next few minutes talking about what differentiates the top SaaS companies from the rest, right? So in order to, well, what we do basically, we help SaaS companies to grow with non-dilutive capital and tools to access these services. These SaaS companies connect in real time the systems. They connect banking data, accounting data, and revenue data, which means that we access all that data in real time and understand what's going on, and we are able to extract these insights. So for the next few minutes, we're going to focus on what are the top 5, 6 variables that differentiate the best SaaS companies from the rest.
So the top SaaS companies are growing really fast, roughly at twice the rate of their peers. In our data set, the top quartile companies at the $1 to $3 million ARR mark grew at 160% year over year versus 100% for the median company. At the $10 to $15 million ARR mark, the top quartile company grew at 100% year over year versus 45% for the median. Again, our data set is comprised of roughly half bootstrap companies and half VC-backed companies. So that might account for some differences in benchmarking that you see from the VC firms' ARR growth metrics.
And another thing that these SaaS companies have in common is super high gross margin. And why is this so important? Like we're seeing that top companies have more than 80% gross margin. And this actually drives most of the value and the high valuations that SaaS companies have. And this is important for a few reasons. One, if you have really high gross margins, your cost base actually increases much slower than your revenue base. So to sign up 100 new customers costs you more or less the same as signing 1 additional customer. So this is, of course, very efficient. Then it also means that if the company runs in trouble or needs to stop growth for a little bit, just stopping investments still means that there's a ton of cash coming through because the existing customers are very efficient from a cash flow point of view. And then how do they reach this? So mostly 3 things. One, they raise prices or don't give discounts. If you think about giving a discount, it sounds very inoffensive at first, but you're actually keeping your same cost base and you're decreasing your top line, so your gross margin decreases a lot. So no discounts or increased prices. 2, very few or no services at all. So services generally have a lower gross margin. So then, like if you bundle both SaaS and services, you're actually hurting the gross margin profile of the company. So then if they actually offer services, these come at a huge premium. So think about 24/7 SLA support. That is really, really expensive to sell. And then 3, most of the upsells and net retention comes from deploying from deploying software and tech-driven features that have close to 100% gross margin. Think about additional integrations or additional workflows. So just focus on those.
Now, in our data set, we saw that the top performing companies achieved 80% according to the Rule of 40. Now, as a refresher, the Rule of 40 is a measure of sustainable growth for SaaS companies. So the equation is profitability margin plus year-over-year revenue growth is the Rule of 40. And you want that number to be above 40% generally. Now, why does the Rule of 40 matter? In this environment, profitability matters more than ever. And if you look at public markets comparables, for 2 companies with the same Rule of 40, the company with the higher profitability margin will achieve a higher valuation.
Then in cash runway, this is probably sounds very obvious, but the best companies have the most runway. And actually, they don't wait until that runway depletes to raise the next round. They raise money, when they have cash in the bank, which means that they have much more leverage negotiating those terms and getting additional funds for the company. So how to achieve a longer runway? We have 3 insights from the best companies. One is they're really, really good at forecasting, right? So they invest in the right tools, in the right team to understand the impact, not right now, but months down the line of adding new people to a team, launching new products, acquiring a competitor, entering new geographies. So they really know what's going on, in the future, and they have the levers to, dial up or down. then they really invest in recovering their CAC as soon as possible. So having a CAC, well, everybody has a CAC, obviously. Having a long payback can actually mean that the faster you grow, the more money you burn, right? And this is counterintuitive, but ideally, the faster you grow, the more money you have. And to do that, you can either get your customers to pay up front. That's not always easy, right? But it really helps. Or two is actually give up on flexible payment terms to your customers, but then finance part of those future payments to recover the CAC up front and be able to redeploy the cash in the future. And yeah, I mean, those two are the key reasons to keep a long runway these days.
And then the final insight from our data set is that diversity yields results. In our analysis, the top quartile companies by ARR growth actually had 10% more female execs than the bottom quartile companies. And within the ZeroOne Advisors portfolio, we see that companies with more diverse C-suites and founding teams outperform less diverse companies. So given the interesting market moment we're in, we wanted to leave you with some actionable insights based on the data. So first, on forecasting. Forecast in next 12-month increments, update your assumptions frequently, and build multiple scenarios. So first on scenarios. You should always have a base case which guides your business. That's the case that you show to the board and is the case that you execute against day to day. Then at a minimum, you should have an upside and a downside case if things go better or worse than planned. Next, on next 12 months. So I think there's a common error in that people set financial forecasts only at the beginning of their fiscal period and don't revisit them. Forecasts should be living documents that you are constantly updating. Then on the updating point, revisit your assumptions often. When you're making forecasts, often it's just intelligent guesswork if your company history isn't that old, but it's important to be constantly plugging in new assumptions to those to make them accurate. Second, on venture capital. So if you need to raise venture capital, preparation is important, both in terms of process and in terms of expectation alignment. So on process, there is a standard punch list of documents that most investors at the stages we're talking about are going to ask for. That includes financial projections, deck, sales forecast, et cetera. So make sure you have those documents ready and make sure they are accurate and defensible. In 2022, investor due diligence is back, and you will get challenged on those assumptions more than you ever have. Then on expectation alignment, your VCs are pressure testing you on your motivations, so it's fair to do the same to them when you're at the final yard line. Understand what success looks like for them because it will dictate how they want you to run your business. Then finally, unit economics matter more than ever. So again, in 2022, profitability eclipsed growth as the primary set of metrics that investors care about. And I have even seen prospective employees get more savvy to the fact that companies need to be fueled by healthy growth. So on the unit economics front, be sure to focus on profitability and be cognizant of the fact that capital sources are not as prevalent as they used to be, and consider alternative sources rather than venture capital.
Cool. And just to wrap up, again, focus on, well, besides everything that Kristen said, focus on what the best companies are doing, right? So focus on gross margin, no discounts, and higher pricing if possible. Like usually, like our biggest mistake as entrepreneurs is to charge less because we think that, our products are somehow worth less than they are. So increase prices, don't give discounts. 2, focus on recovering your CAC as quickly as possible. Like think about it. If you have a CAC of $10,000 and you can recover it today, then you can get that money and immediately get another customer, as opposed to wait for 7 to 16 months to get the money back. And then 3, and this is probably like also counterintuitive, the best companies are usually built by repeat founders. They learn from the mistakes. We can all learn from the advantages now, but one key thing is to align, well, to first of all, diversify sources of capital, and then align those sources of capital with different uses of capital, right? So traditionally we have venture capital and venture debt, very long term, we're looking at 4 years plus of horizon of investment. So align those to pay for things that take a lot of time to pay back. Things like engineering, new products, new geographies, things that If they work out, it's going to be amazing. If they don't work out, it's okay because you have the long term to figure it out. And then things that are predictable and that you can sink almost infinite money in, that's user acquisition, working capital, and things like that. Don't use equity because it's extremely expensive, and use something else that's much cheaper and shorter term. This can literally bring your runway from whatever it is to twice the amount at very little cost, and also with little dilution or overhead. So thank you everybody for joining us today, and yeah, you can get the report from our website.